Ever wondered how traders turn a small amount of money into huge profits, or massive losses? That's all thanks to something called leverage. But how does it work? And is it really worth the risk? Let's break it down. Leverage in Forex trading is like using borrowed money to control a much larger position in the market. Imagine you only have $100, but you want to trade like you have $1,000. With 10-to-1 leverage, you can. Sounds powerful, right? $100 x 10-to-1 leverage equals $1,000 trading power. It's like using a lever to lift something heavy. Leverage gives you more power with less effort. But if that weight shifts the wrong way, ouch! In Forex, small price movements can create big changes in your account. With 100-to-1 leverage, just a 1% move against you can wipe out your entire position. High leverage equals high risk. So should you use leverage? Sure, but smartly. Here are 3 quick tips. Keycap 1. Use stop-loss orders. Keycap 2. Start with low leverage. Keycap 3. Never risk more than you can afford to lose. Leverage can boost your gains, but it can also magnify your losses. Use it wisely, and always manage your risk. If you found this helpful, hit that like button, subscribe, and turn on notifications for more trading tips.